Hi everyone. In this video, what I will be doing is walking through an investment analysis, and here I'm going to use an accounting rate of return. I'm also going to use an internal rate of return, payback period, and net present value as part of the analysis. So here's our situation where we're considering an investment where the initial investment is $1,050,000, useful life is 10 years, salvage value $150,000, annual net income generated $100,000, and the company's cost of capital is 14%. And we're assuming a straight line depreciation method. It's probably the more common one, so it's a safe bet to go with that. The first thing that we will do is we will calculate the accounting rate of return. And to do that, you take the annual net income, which is given, and then divide that by the initial investment, which is given. So the $100,000 divided by $1,050,000 is a 10% accounting rate of return. Next, we'll look at the payback period. So you take the initial investment, you divide by the net income plus the initial investment minus the salvage value divided by the useful life. And what we come up with is 5.53 years that it will take to recoup our initial investment. Next, let's take a look at present value calculations. For our initial investment of $1,050,000, that's a cash outflow. That's why we're showing it as a negative number, because it's actually we're actually using that money, and the net present value of that is a table factor of 1, because it's a one-time payout. It's happening right now. So that is the value, the net present value of that investment. So the $1,050,000 is the present value. Years 1 through 10, we are looking at a cash inflow over those 10 years of $190,000. Now, where did I get that $190,000 from? Basically, that is that initial investment of $1,050,000 minus the salvage value divided by the useful life. That comes out to $90,000 a year as far as depreciation. Now, why would we do that? Essentially, the depreciation of an asset, even though we recognize it as an expense, we're not actually paying anything to anybody. It's just a valuation exercise for our books. So we actually have to add that depreciation expense back in, because we're not actually spending it. It's just a valuation method. So if you have questions about that, please leave your questions below, because that's a little difficult sometimes to kind of wrap your head around. But that's where that extra $90,000 is coming from. Then what we do is we look at 10 years, 14%, and we look up the present value of an annuity, because this this cash inflow is happening over several years. And so we want to look at a present value of an annuity, not just a net present value table. And what we get for a table factor is 5.2161. So if we take that $190,000, multiply it by that table factor, we get a present value of $991,059. Then what we do is we look at year 10. And year 10, what we're looking at is that salvage value. And that happens once in year 10. What we do is we take the present value table. That present value table will look at 10 years, 14%, and we get a table factor of 0.2697. So the $150,000 times that table factor of 0.2697 gives us a present value of $40,455. Now, to get the total net present value, you take the cash outflow of $1,050,000, add to that the $991,059 of the present value for years 1 through 10, and then the year 10 present value of $40,455. We have a total NPV of a negative $18,486. So the last question here is, without any calculations, determine if the internal rate of return is less or more than 14%. And in this case, since our total net present value is negative, the internal rate of return is less than 14%. So if you have any questions about this, please leave them below. I'm happy to help answer any questions. It also gives me great feedback on being able to develop better video content. And I look forward to talking with you again on another video.